So let's go to the first article, guys. First article up today is mortgage rates fall to levels not seen since September. Thank God. What a great way to come into the end of the year, start December with mortgage rates falling even further after consecutive weeks of falling in November.
Wow.
Keep it coming. Keep it coming.
Yeah.
You know, all I can say is like you make it seem, Andy, like it was so long ago when we saw these rates. It was just like, yeah,
Well,
you know.
But what happened in between September and December? We had October where it was just
boy.
you know, we started
boy.
rubbing elbows with 8%, and everyone was like, I don't like this. Don't touch me.
It was crazy. That's the time where, you know, I used that example where I had a client with a $740,000 purchase on a townhome here in San Diego, which is pretty nuts, right? With HOA and everything, his payment was like almost $6,700. Why? And this is VA, no money down. Obviously, that's why it's high, but they had excellent credit scores, etc. 7.5%. And when you have to close escrow so early, you got to lock that thing in and you got to go. Otherwise, you know, you roll the dice and hoping that the rates don't go to the 8s.
Bro, right.
And it's been very refreshing the last couple of weeks being able to get that downward pressure of the rates. And going into 2024, I believe this is a great window to start getting, you know, your finances in line, start, you know, checking the water, see how it is going into 2024 for everybody that's looking to buy in the spring. You want to start the process, you know, 3 months beforehand to really get an idea of what you can expect, because once rates continue to drop, just believe me, you're not going to be the only one rushing to join them.
Oh no,
it's not. It's already the case right now.
No.
You're not the only one looking for to buy a house or refinance, even if the rate is what it is today. What was interesting to me about this article is that, you know, it's citing that the 10-year Treasury, which we talk about here a lot on the show, there's a relationship and a correlation between the fixed mortgage rates on the 30-year fixed and the 10-year Treasury yield. So the 10-year Treasury yield dropped to below 4.3% for the first time since September. Now, again, they are not necessarily inextricably linked, but they do run the same course oftentimes. And I think, obviously, as a result of that, you're going to start seeing that, you know, mortgage rates are going to stay around here for a little while, maybe to close out December, because it is just the way that the market is trending towards that. And we have more to talk about that later when it comes to asset managers saying that mortgage-backed securities might be a safe play in the new year too.
Whoa.
Ho, ho, ho. But one thing I wanted to say for those that don't know at home, the 10-year Treasury works kind of like a sneak peek into where you think rates are going to be. So for those at home, if you want to know if rates are going to be up or down, just check the 10-year Treasury, and if it's on the way up, you can expect rates to follow that trend, and if it's on the way down, same thing. So that's one of the tools that you can utilize to know if rates are up or down, or, you know, the direction they'll be heading.
Wow. Is that still working?
Yeah.
Well, for the most part,
it is one of the things that still kind of tracks with one another. But
because I tell you, I mean, this is before you were probably born, Brian, but we used to say if the stock market is going down, interest rates are, you know, have the reverse effect.
But lately I've been seeing.
And now we see both going. It's like, now it's just so hard to understand, you know? It's like, is that? But no, you're absolutely correct.
And it's a fair point for someone who might be a little bit older watching this show, or newer, older or newer, older or younger. You know, there's been a decoupling of a couple things. You know, typically, there would be inverse functions of things. Yes. So if one goes up, the other one goes down. But now it's like one goes up, they both go up. One goes down, they both go down. So, you know, in this case, I mean, look, I think that the positive news, first of all, is that we've come off of the highs of the 8s. Obviously, 8s were only around for just a little bit of time. Yeah. And we've come back down to, below 7s. Yeah. I mean, that is really tremendous news for most people. Again, I know it's relatively speaking because, you know, we still are having people watch that they have a 2.5 VA. They got a 3%, 3.5% back in 2020, 2021. So maybe to them, they're like, oh, it's below 7. That still sucks. But someone who's looking to buy a house and they were confronting 8 maybe, 6-8 weeks ago, now they're talking about 6.75 or 7%. Yeah. That's a heck of a monthly savings when it comes to the cost comparison.
Yeah, one of the good things that I've been seeing with this is we've been seeing inflation's kind of, it's going down gradually.
Easing.
Mm-hmm. And it is easing. So therefore, certain things like even the gas, I was just at the gas pump and I mean, it was like in the low $5. I was actually pretty amazed not to be seeing that 6 and change. It's like, okay, I went from filling my car with $150. Now it was $105. Like, oh, that's
for the regular consumer could be a huge difference.
No, absolutely, absolutely. Even for me now, I get it. Now I could take Tanya on a date. Yeah,
but hey, this week, baby, we can drive a little bit further than just to the office and back.
Let's take that out there.
I heard you saved $45 on gas. You can drive a little faster.
Yeah, you can coast it a little bit more.
But no, giving that, it's just allowing us to our dollar now is getting stretched. So it's a good news, and seeing that the rates are going down, obviously that's another good thing where it gets people to be a little more enticed to, let me take a look at, what buying a home is going to entail.
And that's so, and off air, I think that is one of the sentiment that we are starting to see when we're talking about what's going on and checking the pulse and having our weekly meetings and all that. It's like, hey, people are warmed up to this idea that this is what a new normal might look like. It's like, okay, 3.5, 2.5, that was abnormal. Now on the opposite end, 8, you're like, relatively speaking, 8, that's abnormal. Okay, where are we going to like settle in? And I think we're looking at where we're going to settle in. Yeah. I mean, there's a chance that there's a chance that the Fed will either pause again and will not raise interest rates again, which is probably an indication that this is what we're going to be looking at for the foreseeable future in 2024.
Yeah, I think one of the things that I've been hearing a lot is the Fed and the government conditioning, and I go back to that word conditioning because they'll say 6 to 7, and then on a good day 5%. So they keep saying that, and people are holding the lines to when that happens. And as soon as that happens, and it will, because they already foreshadow it in what they're saying and everything that they mention, if you read between the lines, they'll give you those nuggets. But once that happens, expect the market to get flooded, and we go right back to the same thing. But the thing is that if you join the market right when this happens, then you're already on the tail end of it, and you need to be proactive and get everything in line if you want to have a shot at pulling the trigger before anybody else.
Yeah. Well, I mean, we certainly see a big difference. I mean, just because we're seeing these lower rates doesn't mean that the future, the outlook for the Fed is everything's fine. They still see that there's a lot of uncertainty out there. There's still a lot of work to do. And remember, Senor Uncle Powell said he wants to get to that 2% inflation rate. So we're still far from it.
Yeah.
The other thing is we don't want to reduce the interest rate so drastic, because then we're going to have that invert that you were talking about where now we have deflation, and that's not good.
So a lot of people have been saying, deflation, and I feel like they think about it like, inflation is bad, so deflation must be good. But little do they know that it's actually, not that good for the consumer, because what happens with that, you start seeing a lot of people being laid off.
Yeah, it's
and banks just these last couple of weeks, I don't know if you guys noticed, they've been laying off thousands of workers silently. Hasn't made the head news, but hey, it's happening, and it's only going to happen a lot more from the beginning of the year.
I think that there's a couple force functions. We're talking about inflation. We're talking about the Fed. We're talking about rates. I think one of the things you're going to see is that people who may have been on the sidelines going, I'm not a buyer at 8. Maybe I'm a buyer at 7. Maybe I'm a buyer at 6.5 on the rate. Some of those people will probably come off the sidelines. But again, to the demand point, when rates go low, then the demand that is on the sidelines might come off the sidelines or sitting on the fence, jump off that fence, and try to get in the game, which then means demand is going to keep prices up. Yeah. So I think that we recently talked about, NAR's chief economist, Lawrence Yun. I think he's right. I think rates are probably going to be in 6 to 7% range in 2024, number one. Number two, I think he's right that you're going to see a pretty substantial increase of available homes on the market because of the demand, and the sellers who now are this, golden handcuffs at 2.5 or 3, they're going to, I'm older. I am retiring now in the next year or two, and maybe I do have to just sell and have to go buy at 6 or 6.5. And then that could bring some more inventory.
Yeah. I mean, to Brian's point, I want to reiterate of people being prepared. We see the difference. Like, I wanted to print this out, what our current agency is right now for our conforming loan limit, which is loan limits, under that 426 mark, with 20% down with the 760 mid credit score, 6.625. Unconventional.
Wow.
Government, really we're talking about FHA and VA, 5.75.
Yeah.
Wow. Under 6?
Under 6.
Oh, shoot.
Obviously, the 760 mid credit score, which is good. I mean, I don't know what the average is out there, but
the averages aside, that's somebody's getting that. So that's what I might as well talk about. I'm sorry, I'm surprised that you said like 5. What did you say? 5.75.
5.75. Correct.
That's great. First of all, so everyone who wants a 5.75, then it requires a 7. What did you say? 760.
760 mid credit score.
It takes a 760 to get there.
But that's how fast how things will drop, right?
Dang.
Like in a few days, like 3 days, it'll start. We've been seeing that rate improvement, and just that fast, we're able to see that much of a benefit to whomever is actually current in escrow.
And I believe that it's a lot slower for them to raise rates, but then a lot faster for them to cut. And you're able to see it right now in the pricing, because these last couple of weeks, compared to just a month ago, you're seeing a huge difference. That translates to thousands of dollars.
It's almost like when rates are getting. It's almost like when rates are being ratcheted up. It's kind of like, we gotta wait and see. In the second there's like a pause. Oh, it's over. We instantly know what's happening. We instantly know what's happening next. Which we don't. But
we don't.
It is funny that the behavior behavioral response is completely different when we're going one way versus the other.
Yeah.
Well, I'm glad. These are,
different.
you know, we keep saying these are the months of giving. You know,
Yeah.
we got Thanksgiving, we got Christmas coming up. So I'm just glad that now the consumer gets to get something. You
Yeah.
know, with inflation going down, now we get to get more gas. Like it was my, you know, my circumstances when I went to the fuel pump.
Yeah.
And now with interest rates, when we locked a couple of clients in, I feel like Santa came a little early.
Yeah,
Right,
I think this is going to be really good for people at the end of the year. And again, like forecasting 2024, you know, we're going to turn the page and go into like what the new conforming loan limits look like. But I think this is going to help people because, you know, there's some indications that there's changes on the financial horizon, and where these lower rates are actually going to couple hand in hand with some changing market things.